Understand relationship between bonds and interest rates. It's a very interesting concept. I will try and help you understand with an analogy first to start with. Let's say, for example, if I'm a corporate who intends to raise $50 billion from the market, and I am willing to offer anyone who puts money with me 10% on the corporate bond that I'm coming out with. So, when you give me $50 billion, I will give you a promissory note saying that I will return your money back with interest. That promissory note which I will pay you is the bond. Okay, let's assume that bond has 10% interest, or in the bond language it is called as coupon rate. So I have an investor who's willing to give me $50 billion, $50 billion, versus that I am giving a promissory note that I will pay you your money back with interest. We call that promissory note to be bond. Okay, and I'm also guaranteeing a 10% interest on the money. Now what happens is, let's assume this particular bond starts trading in the market. Now because it is trading in the market, the price is not going to be constant, it will keep moving up or down, right? 6 months hence, I am in need of more $100 billion. Now what do I do in this case? I go back to the investor, tell the investor I am in need of $100 billion. The investor definitely understands that $100 billion is not a small amount, and probably the investor also does not have so much of money, which is why if the investor would put money in my corporate, then he would all obviously want a little more return because the amount of money that I'm asking is way too high. So now I agree to pay 11% for the $10 billion rather the $100 billion. Now try and understand what has happened is, it's my bond one which is trading in the market at 10%. I'm coming out with a new bond which is 11%. Because the interest rates are higher on this particular bond, the demand for this particular bond goes up versus the one listed on the exchange. And hence, the price of the bond which is listed on the exchange, whose demand has fallen, will start falling. Demand goes down, the price falls. Discussion number two is, when I offered a higher interest rate on my bond number two, where will people get the $100 billion from? So typically they sell their older holdings to put in the new holding. That puts more pressure on the bond which is already listed in the market. So what we are trying to understand is that when interest rates from 10% in the market went to 11%, interest rates went up. What happened to the value of the bond? The bond which was traded in the market, fell in value because people started selling those bonds. This gives us a very simple understanding of what the relationship between the bond and the interest rate is. So we're saying whenever interest rates go up, you will always see a drop in value of the bond which is currently trading in the market. Why? Is because when the interest rate goes up, automatically demand for the higher interest rate bond increases, where people start selling the lower interest rate bond in the market. And the inverse is equally true. I was offering you 10%, but the new bond that I came out with, is a bond in which I'm offering you only 9%. Automatically, the demand will move towards the 10% bond listed on the exchange. More people would want to buy the 10% bond, and hence the value of the 10% bond will go up. So when the interest rate dropped from 10% to 9%, the value of my bond went up because people started buying that bond. So the relationship between bonds and interest rate, bond value and interest rate, is inverse. One goes up, another goes down. Now let's try and understand a little more practically of how it works. So say for example, in India, there is a bond listed which is going to mature in 2023. This 2023 maturity bond was sold at 7.16%. So it is going to mature in 2023. It was sold at 7.16%. And it was sold at 100 rupees face value, which means you give 100 rupees, you will get one bond which will mature in 2023 and you will be paid 7.16% interest or coupon on the bond. Now this bond is listed on the exchange, listed and traded. Now what happens when this bond is traded? Suddenly you see RBI increasing the repo rate. Suddenly you see RBI increasing the repo rate. Now please understand, repo rate is considered to be the leading interest rate in the country. So when people talk about interest rates going up, interest rates going down, what interest rate are they talking about? They are talking about the repo rate, because the repo rate is considered to be the interest rate. So when RBI increases the repo rate, which means interest rates in the country have gone up, which means now there is a possibility that the 7.16 bond which was sold in the market, the new bond that comes out might pay 7.50 because interest rates have gone up. Now that the interest rates have gone up, what will people do with the 7.16 bond which is listed on the exchange? They'll start selling it. So interest rates went up, value of the bond will drop, and now it will start trading at 95. I hope it is absolutely clear to you all. Thanks so much.